Exactly 4 years ago, I was checking up in the morning on 25th February 2020, I also participated in a similar event, a conclave on banking and financial services, which was arranged by the Mint. After that, a lot of things have happened. Much water has flown under whichever river you wish to mention. The world has changed. India has changed. And as Ravi Krishnan rightly pointed out, the Indian banking and financial services sector has also hugely changed and changed for the better. Therefore, at the outset, I would like to thank the organizers of this event, the Mint, for having invited me to be here. And it feels really good to see so many players who are so active and direct participants of the financial services sector. What I am planning to do is I wish to speak for about 20 minutes or so. Thereafter, we can have a conversation. There will be some Q&A. And so that's how we will proceed. Broadly, what I have decided is that I would like to focus on the turnaround in the Indian banking sector. So that is the area of my focus. Now, not very long ago, the Indian banking sector was, beset with a host of challenges and problems. Indian banks were weighed down by high levels of non-performing assets, while the returns on assets and quality and equity were in the negative zone. 11 banks were under the Reserve Bank's prompt corrective action as at the end of June 2018. Failure of a major non-banking financial company stoked fear and risk aversion among market participants, leading to increased costs of market borrowing, especially for those with perceived asset liability mismatches. Even as we were coping up with the stress in the financial sector caused by this failure of the IL&FS, the COVID-19 pandemic in the beginning of the year 2020 came as a shocker, which led to major disruptions across all sectors. During the last 5 years, the Reserve Bank took a series of initiatives on the regulatory and supervisory fronts, while banks themselves, to their credit, responded to the challenges by strengthening their internal defense mechanisms. As a result of these concerted efforts, there has been a gradual and consistent turnaround in the Indian banking system, despite the multitude of headwinds emanating from COVID-19, geopolitical conflicts, and sharp monetary policy tightening almost in every country in the world. All the key indicators of scheduled commercial banks, namely capital adequacy, asset quality, profitability, and similar other parameters, have now shown improvement in the last 4 years. And this was not a mean achievement, because I think if you recollect in the recollectable human history, let's say of the last 7 or 8 decades, or at least in the last 100 years, I think one after the other, so many crises and so many headwinds of such proportion and such intensity, and with such huge impact, not only on the financial sector but the real sector. I think this is a unique period in the sense, we had the COVID-19 pandemic, then the onset of the war in Ukraine, which is still continuing, has not ended. There are wars happening elsewhere, geopolitical conflicts, synchronized monetary policy tightening. So therefore, I think it is to the credit of, the Indian financial services sector to have not only withstood this, but to have emerged out of these crises in a far better shape than the banks or the NBFCs or the financial sector entities were when we entered this period of massive difficulty. Now, the financial indicators of non-banking financial companies are also in line with that of the banking system as per the latest available data. On the whole, India's banking sector has emerged, as I just said, on the whole, India's banking sector has emerged stronger from the unprecedented challenges of the recent years. Questions are often raised as to how this turnaround in the banking sector took place. My short answer to this question is that it is the result of all the good work of various stakeholders in the system. In my address today, I have therefore chosen to speak on the Reserve Bank's efforts to steady the economic ship amidst turbulent waters in the last few years. I have structured my talk in the following manner. First, I shall speak on our response to various crises, starting with the non-banking finance companies, that is the NBFC sector stress that haunted us even before the onset of the pandemic. Next, I shall dwell upon the body of work we have undertaken in recent years to revamp our regulation and supervision. Now, as to how we navigated through the crisis, I don't want to spend much time. It is there in my written text of my speech. A copy of the speech will be uploaded in the RBI website soon after this session is over. So those of you who are interested can have a look at it, because this is already well documented, and I have spoken about it at length in various other fora about how we dealt with the multiple crises which we encountered, starting with the failure of the ILFS and thereafter the COVID and war and the continuing challenges. But let me just say that in the aftermath of the infrastructure leasing and financial services crisis, the Reserve Bank heightened its focus on maintaining and fostering macroeconomic stability through a series of conventional and unconventional measures. The flexibility provided in the flexible inflation targeting framework was also utilized by us to deal with the monetary policy issues and provide the required support which the economy required during this period. So as I said, that whole period of the challenges coming from the ILFS crisis, I am skipping. I don't want to go through that. You may probably, those of you who are interested can have a look at it when it is uploaded. Now let me proceed to strengthening the regulatory architecture. While dealing with the COVID-19 pandemic related challenges, we announced and implemented a series of structural measures all through this period to strengthen our regulatory systems, shifting from an entity-based approach to a more principle and activity-based approach. These measures have played a key role in not only averting a crisis, but also enabling the financial sector and the economy to emerge stronger and healthier from the multiple crises that we experienced in the last few years. Now, during that time, a number of people, when we came out with many regulatory measures, which I will just mention, a few people, not a number of people, a few people were asking me that is it the right time to bring about these changes when the economy is beset with so many problems, the financial sector is experiencing huge crisis emanating from the impact of COVID. So why do you do it, why do you do it now? Why don't you do it later when everything normalizes? I said, look, the way the world is now developing, to expect that the situation will be normal, again, your definition of normal and somebody else's definition of normal will vary. So therefore, if there are required regulatory changes, they should be done now, because there is never a good time, to sort of do things. If you feel something is necessary, yes, the timing of your intervention, the timing of your measures are very important. But timing it does not mean, sort of just postponing issues which are considered as necessary. And we thought that the regulatory and supervisory changes which we were bringing about, our effort was to introduce them in the most non-disruptive manner that was possible, and not take the market by any negative surprise, but to see that seamlessly and without any major friction or difficulty, the new regulatory architecture or the supervisory methods, they sort of seep into the system. So in the recent period, that is from 2020 onwards, the Reserve Bank has undertaken a complete overhaul of the regulatory architecture of the banking system. The regulatory steps include, among other things, just to give a few examples, the list is pretty long. It includes the implementation of leverage ratio in June 2019, large exposure framework June 2019, guidelines on appointment of directors and constitution of committees of the boards of banks in April 21, revised guidelines on securitization of standard assets and transfer of loan exposures, September 2021, scale-based regulatory framework for NBFCs, October 2021, revised regulatory framework for urban cooperative banks, July 2022, and guidelines on digital lending in September 2022. So you will see that throughout this period, beginning 2019 till now, we have been bringing about new regulatory architecture to add that necessary robustness into the financial system. For example, when we issued the digital lending guidelines, there were questions and there were some opinions that if you issue guidelines for digital lending, will it stifle the fintech, the lending by the fintech sector? And are we sort of stifling growth in that sector? But believe me, in fact, the data, you can look at the data. After we came out with the guidelines, if you go by the data will establish unambiguously that the confidence of private sector investors in the fintech lending sector has gone up. Not just anecdotally, but in terms of actual data. I have been told by a number of serious players in the fintech lending space that the fact that the regulator has now provided a framework, an overarching framework in which the fintech lenders or the fintech, let's say even the app providers and others who sort of operate, gives a greater confidence to the investors. So the flow of investment into the fintech space, particularly with reference to digital lending, has really grown, and the confidence in our system has really gone up. So therefore, and as you are aware, we had formed a a group to study this with external experts, to study the challenges and the problems in the fintech, lending in the digital lending space. And based on detailed consultations, wide consultations, our guidelines were issued. So therefore, the regulatory architecture, if you look at it and compare it with what we had 5 years ago, I think the entire financial services sector space, the Reserve Bank has been able to bring in a new set of regulatory guidelines and framework which gives confidence to all the stakeholders, in not only domestic but also foreign players, when they are looking at India. And many of the things we are actually, what we have done is, India has become a pioneer in many of these areas. Of course, with regard to fintech apps and all, there are some issues, but the issues are mostly pertaining to the illegal apps which have their own different business practices, and that is a problem with which both the government and the Reserve Bank and other authorities we are dealing with that. Now, the capital and liquidity requirements which we have now introduced uniformly, they apply to all scheduled commercial banks, irrespective of their asset size and exposures. We nudged the banks for achieving complete automation of income recognition, asset classification, and provisioning processes. Notably, while the guidelines to this effect were issued as early as 2011, their full implementation was pending for a number of years. But we were able to work closely with the banks to ensure that this automation of the recognition of the NPAs was introduced into the systems of all scheduled commercial banks. Further, additional guidelines were issued in 2020 to ensure the completeness and integrity of this process. I would now like to highlight some of the other facets of Reserve Bank's regulatory efforts. There are 6 points here to which I wish to draw your attention. First, I have already touched upon it, is fostering a sustainable digital lending landscape. Post-pandemic, digital lending has seen an exponential rise in various emerging economies, including India. At the same time, it has raised a host of business conduct issues. Consequently, various regulatory dilemmas have emerged, wherein a balanced approach had to be taken. It was necessary to weigh the customer benefits brought in by innovative business models of fintechs on the one side and the emerging business conduct and regulatory concerns on the other. The outcome of the Reserve Bank's regulatory balance was reflected in the digital lending guidelines issued in September 2022, followed by the guidelines on first loss default guarantee, that is FLDG, in June 23, covering prudential concerns and other salient facets of outsourcing, business conduct, data privacy, and digital lending operation. The regulatory objective was to rein in negative externalities while retaining the salutary effects of innovative digital models. And as I said, the data on private equity flows into digital lending space after the issuance of these guidelines demonstrate the faith of investors on the Indian digital lending story and the belief that going forward, digital lending under the regulatory gaze of the Reserve Bank, that is the regulator, will spur the fintech sector even more. In furtherance of this objective and as a part of our efforts to accelerate and widen the reach of digital banking services, the concept of digital banking units, that is DBUs, were introduced. The second point in this regard, I said there are 6 points. The second point is on firming up of governance in the regulated entities. Our focus in recent years has been on strengthening the governance and assurance functions in the regulated entities. Banks and that is regulated in entities including banks and NBFCs to enhance their internal lines of defense. The emphasis has been on building an environment of trust, transparency, and accountability. The assurance functions, namely risk management, compliance, and internal audit, are critical links between governance and business. The key to identify risks early, monitor them closely, and manage them effectively is the real challenge, and that needs to be achieved. In this context, instilling an appropriate risk culture in the organization is very important. This needs to be driven by the board and senior management with effective accountability at all levels. We expect the senior management, the board of directors, the audit and risk management committees, and the internal audit function in banks to play a more proactive role and be more watchful of incipient and emerging risks. The Reserve Bank has issued detailed guidelines for ensuring quality and independence of the governance and assurance functions. These areas are also subjected to intensive supervisory assessment. The third area is reimagining regulations with a pro-customer perspective. We have given renewed focus on strengthening the conduct-related aspects. Instructions have been issued on the responsibilities of regulated entities to ensure avoidance of intimidation or harassment of customers by their recovery agents. The master directions on issuance of cards have also strengthened the conduct regulations relating to various aspects of card operations. Now, we have also addressed the issue of quick resolution of customer grievances by the regulated entities. Accordingly, the ombudsman scheme the integrated ombudsman scheme has been introduced in RBI, and the internal ombudsman scheme in banks and other financial entities are also have been strengthened. And the fourth point I would like to mention is sustainable finance initiatives. Given the significant challenges from climate risks, a dedicated sustainable finance group has been institutionalized in the Reserve Bank. Besides actively participating in dialogue with various stakeholders at international and domestic levels, the focus has been to kindle brainstorming among regulated entities to internally review the systems, processes, policies, and oversight towards sustainable finances and the way forward. The fifth point relates to the measures we have taken to develop the credit market. There also a number of steps have been taken. I have already touched upon some of them. We have issued the guidelines for securitization of standard assets, transfer of loan exposures. A discussion paper has also been issued on the framework for securitizing stressed assets, which is almost, the comments have come, and we will be issuing the necessary guidelines on this very shortly. The sixth point and the final point with regard to regulation is the macro-prudential measures. While we continue with our endeavor towards reorienting financial system, our focus is on broader systemic stability and addressing the incipient signs of imprudent practices, if any, that continues. Considering the persistent credit growth in certain segments of retail credit, preemptive measures were announced, as you are aware, in November last year to sober down undue exuberance, which was clearly visible. Risk weights in certain segments of consumer credit have therefore been enhanced. The issue of interconnectedness through bank lending to NBFCs has also been addressed through higher risk weights. More recently, concerns on evergreening on account of regulatory arbitrage between lenders and the alternative credit channels, that is the AIFs, have similarly been addressed in December last, that is in December 2023. Now let me quickly turn to the revamping the Reserve Bank's supervisory processes. Structural changes have also been implemented to enhance the agility, flexibility, and specialization of our supervisory structure. The Reserve Bank's supervisory systems have been recalibrated to attune them to the dynamics of the financial sector in a forward-looking approach so as to smell possible distresses early. The emphasis is on fostering resilience of the supervised entities at three levels: financial, operational, and organizational. Needless to say, it is a constantly evolving process, but it has been made more dynamic. In this context, I wish to highlight 5 aspects, and I will run through them very quickly. First is the unification of the regulatory and the supervisory arms within the Reserve Bank. Earlier we had in the regulation side, we had about 2 or 3 departments. In the supervision side also, we had a separate department for the banking, then for non-banks, for cooperatives. Now all that has been integrated. We have one department of regulation and one department of supervision, and there is very close interaction and interaction and discussion and internal exchange of thoughts and ideas between them. Now this unified, harmonized approach has led to regulatory efficiency and effective oversight. It has enabled early and timely detection of cross linkages across the sectors, as well as it has established synergy of regulatory and supervisory approaches. By no means, however, we have adopted a one-size-fits-all model. The rationale was to bring an activity-based supervisory approach in addition to doing entity-based supervision. The second point is with regard to the on-site supervision. The on-site supervision has now been made, is now been made much closer, and they get detailed analytical feedback from the offsite supervision, the wing in the Reserve Bank, which does offsite monitoring through the various data which flows in, and based on risks or problems identified in individual bank or NBFC, that information is provided to the on-site inspection teams, and when they visit a bank or an NBFCs, they know that these are the problem areas. Of course, there's a standard protocol they follow, but they are already well fed with adequate information by the off-site teams as to which are the critical areas that need to be looked into. Now the underlying objective binding all these initiatives is to be proactive and ever vigilant in identifying and addressing the emerging risks and vulnerabilities. In fact, the recent regulatory macroprudential measures which we announced were a result of this kind of supervision. And the on-site supervision also engages directly with the management, even with the internal auditors in the banks, with the statutory auditors, so its scope has been substantially enhanced. Third point is with regard to off-site supervision, which has now embarked upon much sharper analysis. We have considerably strengthened supervisory macro and micro data analytics to capture potential and emerging risks. We deep dive into business models of banks and other lending entities and closely monitor their asset liability mismatches and funding stability. We have a system of early warning signals that provide lead indications of risk buildup. While asset quality and capital position indicate resilience and robustness of the financial institutions in the medium term, recent experience in certain advanced economies have shown that liquidity can become an immediate cause of crisis. We monitor the liquidity position of not only the banks but also of the non-banks. Now, in strengthening off-site data analytics, models have been developed with suitable and judicious use of machine learning. The risk-based supervisory rating models have also been recast on the basis of feedback both from internal and external experts. Thus our whole approach to supervision is to be proactive for minimizing surprises and spotting the challenging areas and the concerns and addressing them early. The fifth point is with regard to sustained focus on capacity building. As you know, we have set up the College of Supervisors. Internally, we are also, we have really expanded the size of our supervision department. Continuously, the officers in the supervision department are put to various new training programs, and the College of Supervisors, which we have set up within RBI, is assisting this process. Now, the fifth and final point is enhanced focus on IT and cyber security risks. I think going forward, for all financial institutions, the robustness of their IT systems and the threat from cyber security can become a major challenge. So our emphasis is, as a part of our supervision, we also look at the IT systems of the banks and NBFCs, the banks more particularly. Our C-site team, we have the wing which looks into the robustness of the IT systems. They go deep into the IT systems of various banks and also, as I said, non-NBFCs. And wherever we see gaps or loopholes, it's immediately brought to the notice of the management and to take corrective measures. You see, there has been some comments here and there mentioned. Some people tell me privately that, look, I think the financial sector, the banking sector or the NBFC sector, sometimes they feel that there is overdose of regulation or overdose of supervision. Now, that comment I do hear from time to time. But I think all serious players in the banking sector, including the senior management in banks, I can tell you with a reasonable amount of confidence, based on my conversation with them. In any case, I encourage them on a one-to-one meeting. I encourage each bank CEO to speak to me as frankly as possible and not be not be overawed by the fact that, I am the governor and, we are the regulator. One-on-one, I ask them, in private, what are the possible, how do you see our, regulation or supervision? And take it from me, I do get inputs from bank CEOs about possible areas of risk build-up in the banking sector and in the NBFC sector. In the last 6 to 8 months, a few of, I would not say a number of, but at least 2 or 3 bank CEOs have in private shared with me, sir, and told me that these are the areas which they are getting also worried. And they have So therefore, our primary emphasis is to ensure that the Indian banking system, the Indian financial services system, the NBFC sector, and the entire, the financial sector which is under the regulatory purview of the Reserve Bank, our emphasis is to ensure that they remain resilient and they are robust and they are fully prepared to support India's journey to becoming an advanced economy. And with that, we work very closely with the managements of banks and NBFCs. Our approach is very consultative, and so whatever we do, it is done in a very consultative manner, and that is demonstrated by the fact that most of the regulatory guidelines which we issue, either we issue a discussion paper first, get comments, or we issue a draft circular, a draft master direction, get the feedback from the players, and then we act upon it. Now let me conclude. In conclusion, I would like to say that the remarkable turnaround in the Indian banking system has been the cornerstone of India's success story in the recent years. Today, the Indian banking system is well placed to support India's growth story in the years ahead. Trust is the essence of a robust financial system and is built over a period of time through sustained efforts. This needs to be preserved. The Reserve Bank has committed itself to safeguard the trust factor in the Indian financial system. Our recent efforts to improve regulation and supervision are guided by this basic principle. With our diverse responsibilities, that is Reserve Bank's diverse responsibilities such as being the monetary authority, the regulator and supervisor of banks and non-banks, the regulator of payment systems and other segments of the financial markets, we have used all our instruments, monetary policy combined with macroprudential regulation and supervision, synergistically to achieve better outcomes. As we move forward, we guard against any sense of complacency and work tirelessly towards further strengthening India's banking system and the overall financial system. I'll stop here. Thank you very much.
Thank you so much, sir, for that very, very comprehensive.